Today on The Wealth Managers, I have with me Ashish, Gumashta, MD and CEO at Julius Baer. Ashish, such a pleasure having you on the show. Thank you so much for joining in.
Thank you, Ashish.
Tough time for wealth managers like you because you're managing global as well as local money. And, earlier it was just domestics that we needed to worry about. But look what's happening with FANG stocks. I mean, how is it that you tackle investor queries?
So, the tough times are the best times for advisors because your client interaction goes up. You spend more time on portfolios and you get a better perspective of things, and that's when the risk trade actually plays off. So the situation actually is very simple if you really break it up. So let's look at the domestic factors. 12 or 18 months ago, we had a market which was very expensive and valuations were high. We all knew about it, but none of us were able to or were ready to accept it. What's happened in the last 12 months?
Because it was greed which had taken over.
Exactly. So I'll just take you a bit into the history to give you a perspective. So we had demonetization, and demonetization was a great thing for capital markets. So what happened is a lot of money came into the stream of investments, and at that point interest rates were very low. So with that money coming in and investments available, people started investing in mutual funds, PMSs, and while they were investing, people forgot the rule that when you invest in equities, you tend to take a 3 to 5 year view, and money just poured in. And as fund managers continue to get money, they are a long only player and they have to keep investing, and that money kept getting invested and valuations kept getting higher. Now whenever valuations get stretched, you always have some excuse which results in a correction, and that's what's happened in India. But we are very comfortable with the valuations in the current market, and we think it's again a good time to start investing for the investors. As far as the global markets go, I think US is raising interest rates, and all of us knew that these stocks were at expensive valuations and some correction was due. But in all these, we don't see a major crash or any major concern either in the global markets or the local markets.
Okay, but do you believe that because global markets, or actually in particular just the FANG stocks, have just about begun their fall, that's keeping Indian markets a little restricted? While your downside may have been protected because of crude also cooling off now sub 60, at the upside there is that headroom. Also because there are a lot of other triggers lined up. December 11th we have the state, the first state election results as well lined up, and then all the election argument and talk is going to only heat up.
So Aisha, if you see this year, we've had the largest selling by FIIs, and the markets has kind of held itself. So I think this is the first time that the local investor is behaving in a very smart and a very balanced manner. If you see, our SIP book continues to grow. So what you're saying is right, that people are cautious at this point of time, but we are not seeing any signs of panic by the local investor. Now, if you really look at the Indian economy, what impacts us the most? It's oil. And with oil coming down, suddenly your fiscal is under control, your current account is under control, your inflation seems to be under control, and interest rates seem to be close to a peak at this point of time. So 2 years ago you were earning 6% on your fixed income, now you're earning close to 7 to 8% on your fixed income portfolio. Equity valuations have become reasonable. So I think the coming 6 months will be a very interesting period, and we would advise investors to really invest in more financial assets in the coming 6 months.
Yeah, and the coming 6 months, that's the view across the board, is going to be a very volatile and testing time. You don't know what's going to hit you, you don't know who's going to be the next PM in the run-up to the 2019 elections, etc. And you really can't predict what's going to happen in the state elections. How is it that both a conservative as well as an aggressive investor should best try and make use of the volatility that the market is going to pose in the next 6 months?
So, a bit about financial markets. So everybody knows these things, but somehow the discipline is never followed.
You can't apply that. I mean,
so why does one come to a financial market? Why do you invest in financial markets? I think two key reasons. One, we offer you diversification. Second, we offer you liquidity. Now that liquidity also becomes a bane for us who are managing money, because every day the market opens, every day it trades, and there is volatility. So when we get investors who come in, even though they come in with a long-term view, the short-term and the mark-to-market tends to deter their thought process, or it causes them jitters. One more of my experience has been is when clients come and invest with us. When the markets are at a fairly low valuation, we get 1 rupee. When we invest at 1 rupee, that 1 rupee may become 2 or 3. As the market goes up, we get more and more allocation, and at the peak of the market, the investor who was investing 1 rupee gives us 20 rupees.
Yeah.
Now, when that 20 rupee comes down by 15%, the investor loses 3 rupees, while on this 1 rupee, even if he has doubled his money, he tends to lose money. So coming back to asset allocation, that's the key. So along with the asset allocation profile, you need to also see the time frame in which you are investing. So for a conservative investor today, we would say a 70 debt, 30 equity would be a good ratio. However, the 30 equity, you have to see with the 18 month plus time frame, because you have some volatility. You know, you have the elections coming up. US possibly may raise interest rates, and for the long term investor, we are saying a 70-30. However, in that 70-30 of equity, we would also keep 20% tactical cash, which we will deploy in the coming periods. So we are one of the few private banks which offer two very unique products to our clients. One is we have a direct equity desk, so we are quite focused on equities, and we think it's a great way of creating value or alpha for our clients. The second thing is there is a scheme promoted by Government of India called the Liberalized Remittance Scheme, whereby every individual can take $250,000 per person per annum. I think that also becomes a great diversification tool, and we are telling people to look at diversifying and investing internationally also. So not only do they get a genuine hedge to the rupee, but at the same time they can invest in a wider range of investment opportunities.
Okay, I'll come to the global opportunities in just a bit, but since you are so bullish on India equities over the next 18 months, where within the market right now do you find opportunities, and have you been that greedy buyer in the October fall?
So the way our process is run is we are a small team, very focused on what we are doing. And while as a product team or as a management team, we provide focus to our advisors, we also help them to tailor-make portfolios to our clients. Now, in India, what happens is we tend to make general statements. So if you see the composition of our index today, we have a very high weightage on banks and financial services. Yeah. And you've seen some turbulence in that due to ILFS or multiple issues. But actually, if you go and see the other part of the businesses, if you see engineering companies, if you see oil marketing companies, now if you see chemical companies, there are huge opportunities there. With China shutting down their capacities, I think Indian chemical businesses are again doing very well. Similarly, in engineering, demand is coming back. So we are confident in 2019, demand will revive, and 2020 capex cycle will again kick in, So when you see India as a market, the index is not the best barometer to look at. You've got to break it up into subsections. You have open offers which are on, which give you trading opportunities. You have sectors which are doing within that. And that's the idea, that can you get your client to invest in those asset classes or that category, and is it substantial enough to make money? See, it's very easily said that as a wealth manager, we should diversify, we should allocate assets. But sometimes you have to make the client take a meaningful stake. And that's when wealth is created.
A concentrated bet.
A concentrated bet, That's
Where within the global markets do you find that kind of opportunity? Because the most over-owned, hottest sector, the FANG names, or for that matter, the tech names, are now beginning the fall.
So when I see our analyst reports, I think we still like US. And in US, if you see the non-tech, the valuations are at good levels. Similarly, our analysts are also recommending China. Chinese market this year has seen a very sharp correction. So they've also, they are recommending China. So one of the views is that you've seen a very strong dollar, and emerging market currencies have weakened significantly. Now, in the short run, there is a hope that emerging market currencies recover. So that's why the emerging market play becomes good. Emerging market bonds again are at attractive yields.
And you are the only ones who offers clients that benefit of investing in India as well as abroad, overseas, right?
So one of Julius Baer's core business proposition is that we are a pure play private bank, which means this is the only business we are in. Globally, we manage about $400 billion, which is roughly 2,85,000 crores. And the Indian diaspora, it's a very large segment.
Spread all over.
That's right. So if you actually compare us to the players locally, we would be amongst the top 3. We can't give you a breakup in India because being a listed company, we don't disclose sector-wise. So to us, India is not just Aisha sitting here. You may be here, your brother may be living in some jurisdiction. So what we call it is the global Indian. So it is our endeavor to provide the global Indians a seamless opportunity. And we see Indians immigrating to different parts of the world, you know. So, I mean, the world needs us, right?
Go to every corner and there's an Indian there.
We are 1.3 billion people. We'll be solving problems of Japan, Europe, etc. So, I think our focused value proposition is the global Indian. And one of the opportunities available to the residents again is to use the LRS route to invest internationally, and that will be the first taste of diversification which will be available.
And that's your niche at Julius Baer.
That's one of the niche areas.
Okay, great. On that note, we're going to take our very first break in this edition of The Wealth Managers. We've spoken about Julius Baer's view on equities, the fact that they're there to cater to the global Indian. When we come back, we'll talk about all the other asset classes. What about gold? What about real estate? Should they be looked at in the current market environment? That after a very quick break. Back with the Wealth Managers and still in conversation with Ashish Gumashta from Julius Baer. Ashish, a 125-year-old bank. Where do traditional assets like gold as an investment case lie? What is your view on gold? Because you know, we're getting very mixed opinions. Some believe that it's a great hedge because of the currency movement, the dollar volatility, but some say no. I mean, put all your money into fixed income and equity. That's where the alpha is.
So, Julius Baer tracks gold very closely, gold and precious metals.
I'm sure for 125 years, I'm sure it's in your
We've got a unique
history.
trading desk which specializes in it. We come with special coins to commemorate different occasions out there. But the way an Indian investor should view gold is as an insurance. What percentage of his portfolio does he want to insure? When you read global reports of the debt of some of the big developing or the developed nations, and if there is a fear that there is going to be a change of power or currencies may see a shift, then the best hedge traditionally has been gold. So we view gold as an insurance asset, and whatever gives you comfort, 3%, 5%, 10%, and that is how gold should be viewed. However, having said it, we also see that the gold cycle has bottomed out and it's in the first phase of the investment cycle. So as an investment also, we are now looking at it in client portfolios.
Okay, so given Indian current market environment, you would say that at least some part of your portfolio should be
definitely
in gold.
And you should treat it as insurance money, not watch it on a day-to-day mark-to-market basis.
Yeah, absolutely.
It just happens that gold has been such an integral part of Indian households that there is always a percentage of gold which is there. So you have to
default,
see, so you've got to see the big picture, not the ladies' jewelry which is one, but there is always investments in gold which is there, and you've got to see the big picture and then invest there. Okay. But we feel that we are positive on the gold side.
So 5%, 10%, 15%?
Like I said, should be viewed as an insurance, but in single digits.
Okay, in single digits, great. What about real estate?
So very interesting business in India. I think 50% of India's wealth would be in real estate. I don't have any statistics, but my gut tells me there's a significant portion. So the way to view real estate is a yield which you're getting from real estate. Now, if you rent your apartment today, you get a yield of 1 to 3%. And if you rent your commercial property, you get a yield to 4 to 6%. Against that, if AAA debt is giving you 8%, the value proposition is not very good. So I think one should wait. And possibly, I think the bottoming out of real estate has got further
extended,
speeded by the NBFC crisis, you know. So I think it will become a very attractive asset class in the coming years. But at this point of time, because there is no yield in it. The yield of fixed income is higher than the yield of real estate.
How long could this underperformance last?
Very difficult to say, but maybe in a year or two. So these are 7-year cycles, and I think 4 years are already over, 4 to 5 years are already over.
So Ashish, what would you say as a wealth manager are the biggest challenges, considering you're a niche boutique firm? I'm sure, you know, investors also come with a very stagnant mindset. Right. You know, in my conversations with other wealth managers, I've also realized that it's also about changing their mindset, how to get into equities, how to diversify. Is that the challenge that you also face?
So I would break up the challenges at 2 levels.
Sure.
The first is at the RM level or the relationship manager level, and second as a firm, what are the challenges that we face? I think at the relationship manager level, there are a couple of things which I think if an RM does, he could really optimize the returns for the clients or the relationship. Number one is cut your losses, because one mistake tends to wipe out years of good work. We've seen stocks which were at 100 becoming 90, 80, 70, 60. Now, whenever there is a mistake, one of the things which we really try and focus on is make sure that you nip the mistake at the bud itself, so that it doesn't impact the portfolio. I think the second thing is make sure that wherever you're convinced, you make the client take meaningful positions. Because otherwise, what will happen, you may have a great idea, but if the position is not meaningful, then the client doesn't make the commensurate return, The third thing which I see in India is that selling more products doesn't mean more returns. So actually,
keep it simple.
Yeah, actually wealth management is the most boring business. You're dealing with clients year in, year out, talking to them regularly, getting to know the families. So the lesser your activity is, the more the returns tend to be, So
that must be an integral part of your day, right?
That's
just
right.
Meeting people, conversing with them, trying to know their daily needs, and if you can be part of that.
So I think wealth management is one of the best professions you can be in, of course, after your profession, because you guys have the best place. But it's one of the most enriching experiences. In my 25 years as a private banker, 23 years as private banker, 2 years as CEO, I think I've met. This has been one of the most enriching things about my life, where you get to meet a diaspora of people. You learn so much. It energizes you. You get some of your best ideas from them. But there's three things which the relationship manager has to cultivate into his activity. I think, which is what my boss says, which is content, network, and passion. So when you go to meet these people, and you are meeting some of these top personalities, businessmen, promoters, when you go to them, I think first you've got to be passionate about your job, because nobody is going to meet you in the middle of the day and talk about his investments, business. So it could be a evening, it could be a weekend. So you've got to be really passionate 24/7 about your job. The second thing is content, because when you're meeting a successful business or a successful promoter, if you just go and talk something which is of not sense to him, it's not really going to work out. So for 1 hour of talking which we do with a client, it requires 24 hours of content or hard work which is required from us. So I think that is very, very important for relationship managers, whether it's reading about globals, local, about the client's business, understanding what he wants to do, what are his goals, where does he want to reach. And I think the third thing is network, because a lot of our job is actually connecting the dots. Somebody has a problem here, can you solve it? And it's not always about investments, So I think these are the key things which differentiate us as a wealth manager, besides other things of managing portfolio, making sure the returns are there.
You like the general physician who will have problems or other solutions to all problems.
That's right. That's the best way to describe a profession, is that of a GP, which is the old family doctor, where you go to him for any problem that he has, and then he guides you that, okay, you go to an orthopedic, you go here. Very often you don't have any ailments, and a crocin is a solution, and you're trying to look for something sophisticated. And as you get wealthy, you tend to get paranoid, So again, the GP plays a very, very critical role in this. So I think
it's a people's business, right?
That's right. That's right. So I think that's at the relationship manager level. At an organizational level, the challenges are slightly different. I think we are seeing regulations evolve, and I think what the Indian regulator is doing is very good. So we are moving to a model where the advisor tends to earn his fees from the client, and I think that is a great regulatory change. However, any change comes with set of disruption. So I think that would be one of the challenges that we face. The other thing is that nothing good in life comes for free, and a lot of people offer free advice, and that is where the challenge lies. So I think ability to pay for advice, paying a 30 to 40 to 50 to 60 basis points for advice, I think is very, very critical in our business.
Would you say that that's where the competitive arena is amongst the various wealth management firms? That's
right. So what happens today, Aisha, is there is no entry barrier in the business of wealth management. Banks are offering wealth management, financial institutions are offering wealth management, chartered accountants are there, investment advisors are there. Everybody gives advice, and the best advice is given to our clients in parties, where people only talk about their success stories, and next year we have to handle the part of it. So you've rightly said that it is a very competitive environment, but I think people are understanding, regulations are evolving, and that's where challenging times tend to separate the men from the boys.
Absolutely. What would you say as an investment could be a disruptor? In my conversations, I've also realized that many people are opting for alternatives, for instance. Do you think alternatives could be that one asset class, or could be called as a separate asset class altogether in times to come?
Yeah, so if you looked at US and Europe, alternatives as an asset class has emerged as a very significant asset class. I think it's just come to India a few years ago, and as time passes by, it will become a very predominant asset class. However, one has to understand the risks when you are investing in alternative. For example, when you are investing in a long short fund, it's not necessary that every month it will give you a positive return. Over a 12, 18, 24-month period, the return can be positive, but there can be periods when you tend to get negative returns. So as a firm, we are very positive on alternatives as a space, and we see it evolve over a period of time.
In India also, do you identify those opportunities
That's
in alternatives,
right.
as restricted as they may be?
That's
and
right.
small
So
as
India
they may be?
is a fairly restricted market, but the space is evolving, and SEBI has come out with a beautiful set of regulations where they have defined AIFs, and they have defined minimum investment limits also for them. You know, so I think we will see it evolve as a space, definitely.
So I'm curious to know, you meet the who's who, you have such an interesting client profile. What's your daily day like? What is the life in a day of a fund manager
So
or wealth manager?
So like I was telling you, it's actually it's a 24/7 job, and it's one of the best experiences you can have in your life, because what you're doing is you're interacting with some of the best people in the industry. You're learning about them, you're sharing things with them, but behind all the fun is a lot of hard work which has to go in. So invariably one starts early, reads up a bit, because there's so much happening locally, globally. Is the Dow down, up, down? So you start early, you read a bit, then you go to the office, you quickly exchange ideas, and you figure out what's happening in the market, and then you go out and meet clients. So I always encourage my relationship managers to be out on the street. You know, it doesn't make sense sitting in the office. The best learning is outside the office. In fact, even I personally try and make sure that I can at least meet 2 clients a day, because the best feedback comes to you from the clients. You know.
Oh yeah, indeed it does. Ashish, great having you in the show.
Thank
you so
Thank
much
you
for
so
taking the
much.
time and speaking.
Thank you. Thank you.